Calendar this morning, the second reading of the third quarter GDP out 2 hours from now, 8:30 a.m. Eastern time. That will likely set the tone for markets. Now, economists are looking for an increase of 2.1% from the original reading of 1.5%. We will also get a reading on consumer sentiment ahead of the holiday shopping season. Joining us right now is Vining Sparks chief economist Craig Dismuke, along with Cumberland Advisors chairman and CIO David Kotok. Gentlemen, good to see you.
Good morning.
Thank you so much for joining us. So is the GDP number important in your view, and what are you expecting, Craig?
It's slightly important in that it relates to what's going to happen for the fourth quarter GDP number. It's old news at this point, so that's one thing. And when you go back to the first release of third quarter GDP, it was really a pretty good number, even though the headline was 1.5. The biggest factor in there was the big inventory drawdown, which dragged the number down 1.4%. So if it weren't for inventories coming down, we'd have seen 2.9%. So there's really a pretty strong number to begin with. We think the inventory drag wasn't quite as big as was initially estimated. So we'll see a revision up to 2, maybe 2.1%. But again, it's old news, so I don't think it's a huge thing. I think the biggest thing to look at in this report will be corporate profits. It'll be our first look at corporate profits for third quarter, and that'll probably be the most important thing to look at.
David, what are you looking at?
I'm with corporate profits. If you're in the investment business, you can't buy and sell the GDP. You have to buy stocks and bonds and sell stocks and bonds. And this report, I agree, it's old news. We have a much bigger thing in the world now. We have Europe going into recession. We saw the first signs of it in the French hospitality, the latest data, high-frequency data. And we have Germany turning down, and the Volkswagen thing's getting worse. You take the two largest economies in Europe, they are going to show up worldwide over the next 2 quarters.
And that's David, I correct me if I'm wrong, but I think you were one of the only people to actually buy Europe when it was on its knees and going all the way back. And here you are, you're actually saying this is a cycle that is running into this terrorist event.
Well, there's the question. Do you buy Europe currency hedged, with Draghi taking negative rates more negative, and the stocks cheap and getting killed?
I mean,
so
with
what's the answer?
Yeah, a lot of European investors love Draghi. Like, they just want the Draghi. They want the cowbell. They want it. Do you agree with that as a catalyst?
If the interest rate is zero, the mathematical value of an asset is infinity. What is it when it's minus? Is it 2 infinities? I mean, so asset price, investors like assets. Now, if you're in the growth side and you're in Europe and you can't get a job and things are contracting, or a part of that in the U.S. which is not recovering, then you've got trouble.
Got one more meeting of the ECB this year after
December
Thanksgiving.
3rd.
And then we will expect to see more stimulus then. What about the U.S. though? I mean, does that impact U.S. markets? And at this point, do you think we'll get a good jobs number? Does that indicate anything for you, either of you, for the Fed?
Well, I think one of the big implications is that the ECB is moving. I mean, they're facing deflation again. They've got weak growth again. You've got weak growth coming out of Asia. You have Japan, who's had a second quarter of contraction. You have Canada, that's had 2 quarters of contraction. I mean, globally, there's all these challenges. The Fed is on the precipice of raising rates. Fed funds futures are at 72% chance now for December, and the 10-year Treasury is at 2.24. I mean, at 2.24. I mean, yes, what's happening in the Eurozone absolutely is affecting the U.S. markets. It's the German 10-year is down to 49 basis points overnight, and so that's keeping those longer yields anchored, which certainly is a help as a stimulus for stocks.
If you look at, I mean, everything that you just said is really important, particularly when you look at the disconnect currently, like today's price in the U.S. stock market versus what the currency market, the credit market, commodity market is telling you. Does this look a lot like late July to you or not in terms of that disconnect?
So I think it's very similar, yes. But I also think that I think there's a more realistic chance that we actually see a rate increase this time.
Right.
And so if that happens, then I think you continue to see weakness, and I think you see stocks grinding sideways. But again, as long as that Eurozone, that effect of keeping those longer interest rates anchored is in play, it's going to continue to be helpful, at least for the stock valuation.
So they're raising into a slowdown, like you always say.
We haven't seen the Fed raise into a global slowdown.
It's a Fed raise of a quarter, looks like. Draghi goes down, Switzerland goes down, Denmark goes down.
Right.
Sweden goes down. The spread between short-term rates there and here widen. Dollar soars. We have yet to begin to see the strength in the dollar as time evolves.
Right.
Wow,
Now-
so you
now
think
on
the
that,
dollar gets stronger from here?
Yes,
Can you
a lot.
tie that
What
to
do you
what,
bet?
like
What
the
do you bet on based on that?
Well, now there's an issue, and Mr. Tarullo didn't help our banks yesterday by saying they need more capital, more supervision.
Right.
So there's a real question about the big banks. Regional banks, smaller banks, I think, are a good sector. Big banks know how to play in an environment they keep getting punched.
Can you tie it to what we started with, which is corporate profits? I mean, the strong dollar, certainly in S&P 500 profit terms, is not a tailwind. Can you go through how you see the profit cycle?
Well, if profits are flat in reported earnings, $120 for the S&P this year, 125 next year, that's not very dramatic. But if you're earning them in a dollar comparison with a stronger currency, and you're anywhere in the world, where's the flow of funds?
Exactly.
Flow of funds is here. Same thing in the bond side. If you're sitting in a sovereign wealth fund in Abu Dhabi, would you rather own a 10-year German bond and get paid 40 basis points with a 10-year treasury and get over 2? We're a bargain.
Are you surprised that we're not seeing any impact of the terrorists' attacks on markets?
Markets are resilient, but here's the question. Was Paris their version of 9/11 or another sequence in what is an ongoing, terrible string of things that we're going to see for a long time? Or was it a game changer? I think it was a game changer, but there's a debate about that.
And if it's a game changer, markets should react, is what you're saying?
Yes, I think so.
Negatively.
No, well, the markets, the economies will react, but when the offsetting central bank is more negative interest rates, markets will go up in the face of the trouble and tragedy.
That's probably what happened last week.
Yeah, you saw Swiss bond yields hit a new low. I mean, negative 40 basis points on the 10-year.
We have over $2 trillion in sovereign debt in Europe trading with a negative rate now, and it's growing every day.
Want to give a shout out to Conquer, your team for St. Jude's Children's Hospital. Craig?
Thank you. Yes.
We're rooting for your son.
Well, thank you.
Go St. Jude's.
Yes.
Thank you, Craig Dismuke, David Kotok. Good to see you both, gentlemen.
Nice
We
to see
appreciate
you.
it very much. The